Hello everyone, it is Wednesday, April 28th. Welcome to the chart of the day. I am your host, the Cowboy. This is Elliott Wave Cafe. Today we're going to take a look at the SP 500. Let's get going. All right, so I think I've talked about this about 10 days ago was the last time we've done a video on the SP 500. Things have been looking a little bit messy. We sold off a little bit. We've had a slew of earnings yesterday, today, pretty mixed picture in there, but not as bad as, let's say, the last earnings season. Last earnings season was really, really horrible. So, we'll see what happens, but some companies are doing obviously better than others, but even the ones that have weak earnings, they're not as horrible, so the market is not really reacting much. All right, so let's just take a look here on a 2-day chart on the S&P 500. We're still under an Elliott wave scenario. I'm thinking this is a second wave and not a fourth, and then this is another wave 1 in here with as an alternate in here with a possible wave 2. But the other idea is that this is a 1, 2, 3, 4, and 5, right? For this wave 1. So I'm thinking that this wave 1 will probably terminate on a new high, then get the pullback. If this wave 1 is already complete here, then there could be something else going on, and this could get a little bit deeper in terms of retracement, and I'll show you that in a second. So I just wanted to kind of remind you a little bit of my longer term picture on the S&P 500. I have a bearish count as well, as I'm looking at this as a fourth, but I don't think it's important to talk about it at the moment. If you want to look at that, check out the last video. So you go in my YouTube and you'll see, I think, a video from April 18th on that. Coming back to a smaller time frame in here. No, actually, yes. This is the video from April 18, the slide, and I wanted to show you how we were looking for the C wave decline to unfold and maybe take part in a triangle or who knows, maybe a double zigzag. But here is that slide, April 18, and here we are back into April 28th. So this move kind of happened here. We did a sell-off. Now, it's not necessarily a 5-wave decline. It doesn't look like that. It looks like you have a little bit of a pause back in here, which can qualify for more of a 3-wave move, and that would make it as a wave C of a triangle. So you come down in A, up in B, possible C wave above the A wave low, then push higher next in this wave D. So we can have a rally here for the next maybe couple of weeks, and then do an E, complete a fourth wave, and then push higher somewhere in the 23.6% retracement, which is standard for a 4v3. Now you notice in here also that I have an alternate, and I do alternates. You do a horizontal line and then you put your count below that or above it, and this looks at this a possible fourth wave, let's say, as a double zigzag. So you look at this as an A, B down in C for a wave A, and that creates, for a wave W, right? That creates, so an ABC, it's the first zigzag, creates a wave W. Then you go up in an ABC and you create an X wave. That X wave usually comes at the prior B wave, right in there, right? And then you go down and you do another wave Y, which means that you would have a 1, 2, 3, maybe a 4 and a 5 for an A. Then you go up in B, and then you go down in C again, and you create a WXY, and then this correction gets a little bit deeper. Now, if that's the case, this fourth wave scenario might start to come under question. It needs to happen fairly quick because of the size that this is going to be compared with the wave 2 back in here. So if we're thinking of it as a fourth wave, it kind of needs to happen fast. Otherwise, we would have to switch to a 1 and then a wave 2 in progress. That's going to be a WXY kind of coming lower in the S&P 500. Now, on the next few slides, I'll show you here some sentiment readings that I have and some seasonality as well. And then you can see how, kind of how I'm looking, how I'm thinking about these moves in here maybe being a little bit too extreme. So I think this is the one that's probably going to pan out. And it's a little bit different from NASDAQ because NASDAQ just made a new low, and I've done a video about it, a little while ago here, a few days back. So check that out too. But So this is kind of what I'm thinking about the S&P 500 at the moment. The other one, you know, if you really want to kind of dive down into some more Elliott wave in here, you might think, hey, what if it's a flat? So you can have a 3, you can have a 3 up in B, and then you can have a 5-wave decline in C, and you could be done. Let's say maybe one more low, and you have 3 down in 5 for a flat formation, and then you push to new highs. The problem is this B wave has not really retraced, 90% of this A wave, so that's a little bit of a, of an issue there. Otherwise, and maybe the proportionality of the C wave compared with the wave A, again, it's not that clean. So, that's why I'm not necessarily, showing it in here or giving it a higher probability. So I'll stick with the triangle for now, see what happens. But I think we'll probably, even if you make a new low, we're due for a bounce in here pretty soon. So that's kind of what we're going to be watching here over the next several weeks. Now, the sentiment in the market is pretty extreme. These charts are a courtesy of Sentiment Trader in here, and you can see this is basically a risk on, risk off indicator. Every time is below 50. That means that you are in a risk off mode. I've talked about this. We had a webinar this morning at about 6:30 till about 8 with the members in my program, and we've gone through a bunch of stuff there as well. And this was one of the charts that I showed in there on our discussions. And there's actually about 21 indicators that compose this larger risk on, risk off indicator. And every time it's in the red, here people are more fearful, and you're looking at more of a negative sentiment and bearish sentiment in the market. And, for it to kind of start to have traction to the upside, to regain the confidence in the market, you kind of have to go back above this 50% line. And it's not, it's nowhere near there. If anything, it's all the way at the lows. And usually when you get that low, you're probably going to get bounces in the market, right? Because it's quite extreme in here. Actually, you even have a little bit of, divergence in here, I would say, right? The S&P 500 is very low. This one has not dropped yet too much. And some of those indicators, if you want to know, they're probably, they're like, up and down volume ratios. And then you look at some dump money confidence in there. So you have the fear and greed model. You got some breadth indicators above the 200-day moving average, what the stocks are doing. You're looking at the AAII bull ratio, which I'll show you in a second as well. Some put call ratios, some VIX term structure, what people think about fear looking down the futures line. So there's several stuff that kind of composes this, and you can take each of them individually and kind of dive down. But basically, this is a quick glance of what the market is thinking at the moment. And then the next one here, I have the seasonality. So here's the thing. We're supposed to have a little bit of a messy beginning of the year. We're supposed to kind of start to accelerate, maybe, starting in, 60 days into this, so a couple of months, right? So you're looking at March, we're already in April, and we're still doing pretty bad when we were supposed to accelerate seasonally in here. But the trend is still up towards the end of the year, maybe a period of kind of a sideways mess, for a few more months. Maybe we're doing a larger triangle. Maybe we're doing that little double zigzag that I was talking about. But we should be able to improve at least for the next, several weeks in here. And then, after the end of then, usually you're getting a little bit of a weakness back in September, October, and then November, November, December are pretty good months towards the end of the year where you start to rally again. So that's something that I'm definitely watching, to see kind of how that relates to the market. But here is the performance, of the current year, right? After 80 days of price action in the market, and, you're down, more than 12% negative. And look at this, right? You're nowhere near, what seasonally you're supposed to have. And now it's not perfect, obviously. And this is data looking back 30 years. So you're taking 30 years of data and just kind of put it on a chart. So every once in a while you get messed up years. But I think this one, it's actually one of the worst years, in the history of the stock market in terms of, its weakness from the beginning of the year till now, right? Usually that happens more towards the end of the year, in the fall months, where you get heavy weakness in the markets, and not necessarily in the beginning of the year. But here we are, right? The market is just showing you what's up. Here is a chart of the AAI bull indicator that I've showed you again, on that demonstration back, about 10 days ago, and we were still doing fine. We're about minus 48.40, and the S&P 500 was hovering about 43.90 at the time. And we've just gotten an update on this thing here yesterday, and here is how it looks right now. So look at this thing, it dropped to minus 59, right? So this is how bearish this investors are here, and on the question, what direction do they feel that the stock market will be in the next 6 months, and they're just ultra bearish in here. The ratio between the bulls and the bears is a minus 42.92, and this in here, it's 2008 financial crisis, 2009. This is the fear that you're having at the moment. With the stocks being 12% of their highs. I mean, I don't know what's going on, but this is, I don't know if this is not a counter indicator. I'm not sure. I think people are just not ready for a rip rally to new highs, and that could be a big surprise. Maybe not, but I'm thinking about it seriously that way. And here is a little bit of a closer look in where we are in the S&P 500, 4287. With the big drop here in the bull bear index. And here is how many people are bearish versus how many people are bullish in there. So very interesting for sure. And then the other indicator is the options equity put to call ratio. A lot of people getting very fearful to the latest drop. I mean, this was a massive climb in people buying protection, right? Just kind of going full on, let's say, get me out of here, buy me puts, whatever, just protect me in case this market crashes lower. And usually when you have spikes like this in the put call ratio, that's kind of significant, and it can kind of lead to low in the markets. I mean, you can see back here, you can see some of them back in here. Look at this guy, right? It's just kind of tells you that those are, moments of extreme fear, and, you probably better suited kind of thinking on the other side for a little while. So, I'm not saying don't protect yourself, but, you want to protect yourself when the market is pushing higher, not necessarily when it's coming to these lows. So I don't know. It's just kind of something that I'm definitely keeping an eye on. I want to show you guys here as well. And then I touched on this. I don't know if it was on the videos that I've done for you guys or for the members, but here is the Dow Jones US Growth Index. And then this is the Dow Jones US Value Index. And this is an RRG graph, a relative rotation, we call it. And, you have leading, weakening, lagging, and improving. And basically, it takes data from these indexes, and you can see there is a drop. In here, this is on a weekly time frame. You're getting a drop in value and a pickup in growth. So this rotation is happening right now. So you might want to look at stocks in the growth area to see if you can find anything that's interesting in there. I talked to the members too about this because, we go down to the sectors, then we go down into the subsectors to go down to the stocks and see, what's looking good, where, you can look to increase investment and decrease them, for that matter. So this is something that's definitely, again, just kind of worth watching. I just wanted to kind of show you guys what's going on in this rotation. And usually what happens is, this is the benchmark right at the center, and this is the Dow Jones index, and you have growth and value. So this shows you kind of how these assets kind of rotate, from value to growth, and they move around, right? And people sometimes, favor value, then they favor growth, and then, you're kind of moving around. So anyway, that's just something that I wanted to kind of share with you. The other one in here, it is this, National Association of Active Investment Manager Index. So this is, active managers and how much exposure they have to the equities. They show you the percentage of allocation that they have to the equity markets, right? Every time you're about, 65, it's considered that they're, kind of bullish, and they're kind of healthy, and looking for things to move higher. They want to put money to work. If it drops below those, they're getting more defensive, and they're you know, they're just kind of looking for protection there. I mean, it's still a pretty good level. I mean, look at this. When you had the 2020 crash, right? They were just almost negative. Then you can get some divergences. You can see in here when they're starting to subtract money from the market and then just kind of move towards safety. And then, you know, like anybody else, you know, there's extremes when people get super excited. They get, you know, they just like throw a bunch of money at this thing and it's like, oh, this thing is going to rip higher. And all of a sudden you're getting a pullback. So we're watching for those signs as well. And this is the RIDEX funds flows. So, you know, when they're moving from risk to safety, if they move towards safety, then, you know, they're going to reduce their exposure. These red lines are going to get bigger. If they want to put funds to work, these red lines are going to get smaller in here. So you can see this this massive move to safety kind of created a low back in there. So these are counter moves, and it's, you know, definitely worth kind of watching. And here is the thing, right? I mean, look at the stocks there, you know, almost like a double bottom at the new lows in here, and you know, they're not that aggressive into moving to safety. So something to definitely watch in there too. So you know, and then the VIX, you're probably familiar with this one. VIX has pushed back higher towards 31, 32. You know, here is a big resistance level in the VIX between 35 and 40. This is back from November of 2020 when we had the spikes, then, you know, back here. So I just kind of put some lines on it. I think I've showed you this maybe on the NASDAQ, or I was talking about, because I was comparing this with Bitcoin as well. So it might be on one of the Bitcoin videos I've done. But anyway, this is, you know, you're coming back into the stocks, you're retesting these lows, and VIX is pushing higher. Now, VIX is not that aggressive, right? You're not like at 35, you're not at 40. So, you know, there is a little bit of fear out there, but, you know, it's less fear than what it was in this big drop back, right? So I'm looking at that as a divergent signal. And usually, you know, it looks like VIX is losing power, which means that, you know, people are fearful, but not as fearful as before. So this could be a positive sign for the market moving forward from these lows. So I'm going to kind of watch that. But you know, definitely a good indicator to watch. Constantly watch the VIX regarding to crypto, to Bitcoins, to what's going on, because they're giving you, you know, pretty good clues overall in kind of what the market is thinking, and taking the other side. So when volatility is so high, you know, I don't know how much you guys do options and stuff. I mean, we've sold a bunch of options today and yesterday and the day before because of the earnings, but it's good to take advantage of when the volatility rises. It kind of rises among all the stocks. So when you sell premium, you sell calls, you sell puts, you do, you know, credit spreads, whatever, you take advantage of high option prices and you sell them rather than buying them, because then when the volatility gets lower, gets crushed in here, right, you're going to get you're going to get pretty good returns on those options, because they're going to suck the volatility out of the market. I don't want to get into the option discussion, but basically, you know, you sell them when they're expensive, and then you buy them back when they're much cheaper because the volatility comes lower. So you're you know, making money on that spread. So anyway, guys, this is the VIX, right? And then I'll close with this. Go ahead and try this. I mean, it's just a little piece that I wrote, you know, for Substack. I'm going to start writing there more regularly. I have something in my mind about discipline, which I'm going to put, I think that's going to be my next article coming up on there. So this is just a little piece on ElliottWaveCafe.substack.com. Tells you a little bit what I'm going to do, and then, you know, a little bit about me and kind of what I think. It's a pretty cool little, you know, little for me to read in there. So go ahead and check that out, subscribe, and then, you know, they'll send emails to your, they'll send my new articles to your email right away, and it's free, and it's, you know, I'm just gonna you know, keep going with it. So again, thank you for watching. Please don't forget to subscribe and like. You know, come and check us out in the program, see what we do, and I'll be talking to you next week. Today's Thursday, so it's the last video. I appreciate you all being here. Thank you very much. Bye bye.